If you're still blindly dumping your paycheck into that classic 60% stocks and 40% bonds portfolio, we need to talk. Because right now, you're taking the money you worked so hard to earn, and you're steering it straight into a financial buzzsaw. The 60-40 rule is the holy grail of traditional investing. It looks prudent, it feels safe, and it's exactly what every financial advisor has been telling you for 40 years. But here's the harsh reality nobody on Wall Street wants to admit. That rule was born in a very specific temporary economic reality, and that reality is completely gone. We're playing a completely different game now, and if we stay anchored to a formula built for a world that no longer exists, we're exposing ourselves to a massive trap. It's a trap where both sides of our portfolio can crash at the exact same time, because the comforting textbook story doesn't match the environment we're living through right now. What we actually need isn't a recycled formula from the 1990s. We need an all-weather bulletproof framework that thinks like the big institutions. We need a portfolio that can actually survive inflation, recession, and whatever else the market decides to throw at us. Let's back up for a second and look at the fairy tale Wall Street sold us for half a century, because the pitch was beautiful in its simplicity. You own stocks for growth, and you own bonds for protection. So when the economy is booming, your stocks go up. When the economy tanks and the stock market bleeds, central banks panic, cutting interest rates to save the day. And when rates fall, bond prices go up. Your bonds act like an umbrella in a thunderstorm. They soften the blow, they steady the ride, and you sleep like a baby. For 40 years, this wasn't just a theory, it actually worked. And financial advisors repeated it like gospel while target date retirement funds hardwired it into their algorithms. Millions of everyday investors accepted it as a permanent law of physics, but that entire system was built on one massive quiet assumption that almost nobody questioned. That quiet assumption was that inflation had to stay dead, and from roughly 1980 to 2020, we lived in a historic golden age of disinflation. The world was globalizing, we were shipping manufacturing across the planet to wherever labor was cheapest, and tech companies were streamlining absolutely everything. The cost of goods kept dropping, and interest rates basically slid down a giant waterslide for 4 straight decades, so inflation wasn't the monster under the bed. The only thing central banks feared was weak demand, so every time the economy even slightly stumbled, the Fed had a blank check to slash rates. They flooded the system with cheap money, and under those perfect laboratory conditions, bonds were magic, acting as the ultimate hedge. Stocks and bonds moved perfectly opposite to each other when it mattered most. But the problem is, we mistook a lucky 40-year weather pattern for global climate. Once inflation stops being a temporary glitch and becomes a structural sticky force in the economy, all the old rules go out the window and the math gets brutal very quickly. Think about what a bond actually is. It's just a promise to pay you a fixed amount of cash in the future, which feels like a warm blanket in a low inflation world. But in a high inflation world, that same fixed income becomes a financial prison. So imagine you own a 10-year government bond paying you 3%. Sounds okay, right? But what if actual inflation in the real world is running at 5%, meaning you aren't making money, and your real purchasing power is quietly bleeding out every single year? You're earning a positive number on a screen, but you can buy fewer groceries, less gas, and less housing, and unfortunately, it gets even worse. When inflation runs hot, central banks are backed into a corner, meaning they have to raise interest rates to kill it. The second they raise rates to 5%, your old 3% bond instantly becomes a complete joke. Why would any rational human being buy your 3% bond when the government is handing out brand new ones paying 5%? They simply wouldn't, so the market violently adjusts the price of your bond downward, and suddenly the safe umbrella you bought for the storm turns into a lightning rod. You're taking heavy losses on the very thing that was supposed to protect you. But wait, because the storm is hitting your stocks too. Stock valuations are entirely based on future cash flows, and when the cost of money goes up, those future profits are mathematically worth less today. This completely vaporizes high-growth tech stocks, those same companies running on the promise of massive profits 10 years down the road. Furthermore, high borrowing costs squeeze corporate profit margins, consumers stop spending, businesses freeze their expansions, and the whole economy pumps the brakes. Look at what just happened. The exact same inflation that destroyed your bond portfolio is now systematically dismantling your stock portfolio. That's the nightmare scenario of the 60-40 split, where what Wall Street sold you as diversification was actually just concentration in disguise. You thought you were spread out safely, but both halves of your money were sitting right inside the exact same blast radius, vulnerable to interest rates and inflation. And if you think this is just some pessimistic theory, history has already handed us the playbook. Look at the 1970s, when the US was choking on stagflation, oil shocks, and policy blunders, making stocks go sideways for an entire decade. You know what actually protected wealth in the 70s, when both stocks and bonds were completely failing you? It wasn't a mix of paper stocks and paper bonds, it was hard assets like gold, energy, and commodities. real physical things, whose prices naturally inflated alongside the cost of living. History might not repeat perfectly, but it definitely rhymes, and right now, the poetry is looking awfully familiar. We're facing structural inflation pressures that cannot be fixed by a central bank tweaking a dial, especially while globalization is fracturing. We're rebuilding supply chains so they're secure rather than just cheap, and geopolitical tensions are completely scrambling our energy and trade routes. Let's talk about the green energy transition, which might be totally necessary, but spoiler alert, it's incredibly expensive. Rebuilding the global energy grid requires a massive physical build-out that will basically keep commodity prices elevated for years. Combine all that with governments buried under mountains of debt, and you have an inflation baseline that's completely different from the 2010s, which is exactly why your portfolio needs a new anchor. When paper currencies are being diluted and paper promises are losing value, hard assets become completely mandatory. You need to remember that inflation is literally just the rising price of real tangible things in the world. If you only own cash and long-term bonds, you are inevitably going to become the victim of inflation. But if you own the tangible, scarce, absolutely necessary materials that run the global economy, inflation is no longer your enemy. It becomes your absolute tailwind. Real diversification isn't just owning different ticker symbols, it's actually owning assets that react to entirely different forces of nature. A stock is just a claim on a business, and a bond is just a claim on a government's promise to pay you back, both of which rely solely on human confidence. Meanwhile, an ounce of gold doesn't have a CEO, and it certainly doesn't care about the Federal Reserve's dot plot. A barrel of oil doesn't need consumer confidence to make an engine run, because these assets simply have value based on being scarce and incredibly useful. So, does this mean you should sell all your stocks and live in a bunker made of gold bars? No, it just means your strategy has to fundamentally evolve because markets naturally rotate through 4 seasons of growth, recession, inflation, and disinflation. The classic 60-40 split was only built for 2 of them, leaving a massive fatal blind spot when inflation gets stubbornly sticky. A true all-weather portfolio fully acknowledges that different economic seasons require completely different gear to survive. In a healthy growth phase, you absolutely want high-quality equities, but certainly not garbage meme stocks. You want companies with vicious competitive advantages, massive free cash flow, and the pricing power to pass rising costs directly to the consumer without blinking. During a deflationary recession, long-term bonds obviously still have a tactical use, but they are just a tool rather than a religion. But when inflation is running hot and growth starts heavily slowing down, that's exactly when you need commodities, and that's when gold steps up. The beauty of this is that you don't need a Wall Street hedge fund to pull this off. You can build this defense system right now in your normal brokerage account. Here is the 3-step adjustment you need to make to fundamentally modernize your money today. First, you need to break your addiction to long-term bonds. So if you want safety and a little yield, stop buying 10-year or 20-year paper. Instead, you should shift your focus to very short-term treasury bills because they give you solid income and act almost exactly like cash. They have virtually 0 interest rate risk, so if rates go up, you don't get crushed. You just roll your money into a new bill paying even more. By doing this, you're literally getting paid to safely wait for much better opportunities to come along. Second, you have to make hard assets a deliberate part of your core strategy, meaning a 10% to 20% allocation into gold and broad commodities. Yes, during calm and boring markets they won't do much and might even lag behind, but the second inflation surprises everyone, this slice of your portfolio becomes your savior. It literally becomes the lifeboat that keeps your total net worth afloat while everyone else around you is sinking. Third, you need to get absolutely ruthless with your stocks, because the era of free money is completely over. The market is totally done rewarding those startup companies with cool presentation decks and absolutely 0 profits. Filter your stocks for brutal efficiency, looking for real earnings, bulletproof balance sheets, reliable dividends, and unshakable pricing power. Quality and consistent cash flow are genuinely the only things that matter when capital actually starts costing money. This isn't about panicking, and it isn't about betting your whole life savings on one doom and gloom scenario. It's about waking up and realizing the map has fundamentally changed. We have an entire generation of investors, trained by the greatest bond bull market in human history. The goal here is not to blindly cling to a tired formula just because it worked for your parents. The actual goal is resilience. You build resilience by owning a mix of assets that genuinely protect each other under completely different, chaotic economic conditions. Ask yourself the hard questions, like what happens to my money if inflation stays at 4% for the next 5 years? You need to figure out what actually protects you if the Fed stubbornly refuses to cut interest rates. The investors who ask those questions today, adjusting their portfolios to reality, are the ones who are going to crush the next decade. The ones still waiting for the 2010s to magically come back are going to learn a very expensive lesson. You have to adapt to the brutal market we actually have right now, not the comfortable market we miss.